Cease all your present activities immediately. I mean everything. If you were poised to click another link, if you were checking your notifications, if you were mapping out your day, halt, because what is about to transpire before you is not some fringe conspiracy theory. It is not a nebulous prophecy from a financial clairvoyant, and it is not merely another instance of market chatter. What I possess is a specter. It is a document that was never meant to see the light of day. It is an internal directive, a high-level memorandum emanating from the inner circle of one of the most colossal, most influential investment banks on the face of planet Earth. This is a dispatch from the heart of the Leviathan, Morgan Stanley. To be precise, it originated from their commodity trading division, the very hub where billions of dollars flow with lightning speed. This memorandum was dispatched 72 hours ago. It was disseminated to their most distinguished institutional clientele, the hedge funds, the sovereign wealth funds, and the ultra-wealthy individuals who constitute the uppermost 1% of the 1%. And it contains 3 words that should send a chill down your spine. Exit all positions. Ponder that particular phrasing for a moment. Within the realm of high finance, words are selected with the meticulousness of a diamond cutter's instrument. They did not suggest reducing exposure. They did not advise rebalancing your portfolio. They did not recommend hedging against potential market fluctuations. They commanded exit. In the lexicon of Wall Street, exit is not a suggestion. It is an evacuation mandate. It is the command issued when a vessel is irrecoverable. It is what you hear when a structure is engulfed in flames and its foundational supports are already groaning under the intense heat. Morgan Stanley, a colossus managing $2 trillion, $3 trillion in client assets, is instructing its associates to abandon the silver market entirely, and they have stipulated a firm deadline, the conclusion of this very month. This is not a recommendation. It is institutional consternation. It signifies that the most astute minds are acknowledging they are positioned atop a time-sensitive explosive, and they have determined that mere days, not weeks or months, but simply days, remain to evacuate the blast zone before the entire edifice disintegrates. I have personally reviewed this memorandum. I've corroborated its authenticity through multiple contacts embedded deeply within the institutional trading sphere. What I am about to impart to you is the most crucial financial intelligence you will receive this year and possibly this decade. When an institution like Morgan Stanley makes a swift departure, it signifies they have detected something within their proprietary risk assessment algorithms that the general public remains entirely oblivious to. It portends a catastrophe that will permanently redefine the precious metals market, engendering a profound chasm between those who heeded the warning and those left amidst the devastation. You are presented with a choice at this juncture. You can dismiss this as further sensationalism, more instances of the boy who cried wolf. Or you can engage and comprehend that what is transpiring behind closed doors on Wall Street is the financial equivalent of witnessing rodents abandoning a foundering vessel. The sagacious investors always perceive it first. They invariably have their escape strategy meticulously planned before the initial drop of water breaches the deck. Allow me to elucidate precisely what Morgan Stanley comprehends. Allow me to reveal why they are retreating. And most critically, allow me to demonstrate what you must do before this evacuation becomes common knowledge and the escape routes become impassable. The memorandum itself is remarkably concise, comprising merely 3 paragraphs, yet every single word constitutes a strategic maneuver. When you are advising clients managing billions to divest their holdings, you dispense with verbose eloquence or marketing platitudes. The initial paragraph outlines the technical impetus. It declares that owing to extraordinary market volatility, and this is the crucial phrase, structural alterations within the silver derivatives market, Morgan Stanley is advising all institutional clients to liquidate every single long and short position in COMEX silver futures, options on futures, and over-the-counter silver swaps. Structural alterations, that is Wall Street's coded language for the system's malfunction. When the framework of a market undergoes transformation, it signifies that the foundational principles, the very gravity that underpins the system, no longer hold sway. It is akin to being informed that the bridge you traverse daily has developed profound, imperceptible fissures in its substructure, and the engineers no longer possess the confidence that it can bear the weight of a single vehicle. You do not attempt to proceed cautiously. You do not endeavor to reduce the load. You close the bridge. The second paragraph addresses the urgency. It stipulates that this recommendation applies to all position magnitudes and all maturity dates, but it appends a disquieting instruction. Clients should prioritize the orderly liquidation of assets over optimizing their sale price. In plain terms, we are unconcerned if you incur losses during your exit. We are unconcerned if you are compelled to sell at an unfavorable valuation. Simply depart. Depart immediately. Sell into whatever liquidity remains, because whatever is imminent at the month's end is infinitely more detrimental than accepting a loss today. That month-end deadline is not arbitrary. It represents a mathematical precipice. Morgan Stanley is aware of an impending event, a confluence of circumstances that will render holding any silver position exceedingly perilous. Then comes the third paragraph, the definitive one. This is where the bank concedes that they are not merely offering counsel, but are orchestrating the withdrawal. It states that Morgan Stanley will be reducing its own proprietary exposure to zero within the same time frame and will cease to engage in any new silver-related business until further notification. Contemplate the implications of that declaration. A global financial institution exists for a singular purpose: to generate revenue. Every transaction, every swap, every client holding represents a source of income. When a bank declines new business, it is essentially foregoing its own remuneration. They are relinquishing millions, potentially billions in fees. They undertake such action only when the risk of remaining in the market is existential. They have concluded that the profit derived from the silver desk is not commensurate with the peril of the silver desk jeopardizing the entire institution. Before we delve deeper into the data, it is imperative to grasp the internal mechanisms by which a memorandum of this nature is generated. A financial institution does not arbitrarily decide to alarm its clientele. Every syllable within that document has undergone rigorous scrutiny by a cadre of legal professionals, compliance officers, and risk management specialists. It likely progressed all the way to the executive leadership. Advising clients to divest their holdings carries substantial legal ramifications. If the institution errs and precipitates a panic that results in unwarranted losses, they face litigation of catastrophic proportions. They forfeit their reputation. They lose their most significant clients. Therefore, the very fact that Morgan Stanley was willing to commit this to writing indicates that their internal models are issuing urgent alarms. They have performed the calculations. They recognize that the risk of being incorrect in their warning is significantly less than the risk of remaining silent. They have ascertained a high probability of a catastrophic event transpiring in the silver market before the month concludes. Now let us examine what they perceive that you do not. Morgan Stanley's commodity trading desk operates with a sense of market omniscience. They observe real-time transaction flows that retail investors cannot even conceive of. They witness the activities of other titans such as JP Morgan, Goldman Sachs, and Citibank operating discreetly. They observe the actual physical movement of the metal because they are active participants in the physical supply chain. They are not perusing news articles and speculating. They are orchestrating the global transit of millions of ounces of metal, and currently their monitors are displaying red alerts. They are witnessing a confluence of three simultaneous crises that are converging at this precise moment. The initial crisis is inventory depletion, and the figures are staggering. The registered silver inventory on the COMEX has plummeted. It has fallen below 32 million ounces. To the average individual, 32 million might seem substantial, but in the context of global finance, it is a minuscule quantity. It represents the lowest level observed in over a decade, but it is not the absolute figure that instills terror in Morgan Stanley. It is the pace of the decline. Merely 6 weeks ago, that registered inventory stood at 41 million ounces. That signifies a reduction of 9 million ounces in a month and a half. This averages out to 1.5 million ounces of physical silver vanishing from the vaults each week. Performing simple arithmetic, at this rate, the registered inventory will reach zero in approximately 21 weeks. However, markets do not progress linearly, they accelerate. In the past 14 days alone, the vault has shed 4 million ounces. If this newly accelerated rate persists, we are facing an empty vault within 8 weeks or less. Now the skeptics will draw attention to the 230 million ounces residing in the eligible category. They will assert that this metal can be transferred to the registered category whenever required. However, here is the undisclosed information that the major financial institutions possess. Eligible metal is not the property of the exchange. It belongs to private entities, affluent families, and hedge funds who utilize the vaults for secure custodianship. They are under absolutely no obligation to relinquish that metal. Given the skyrocketing premiums for physical silver in locations such as Shanghai and London, why would they consent to selling it to the COMEX for the paper price? They will not. The eligible metal is effectively frozen. It does not constitute a reserve supply. It is a privately held cash. This implies that the registered inventory is the sole genuine safeguard for the system, and it is rapidly diminishing. The second crisis is the surge in delivery requests. To comprehend this, one must understand the significant deception of the silver market. Historically, the silver market is a paper-based market. For every 1 ounce of actual physical silver, there are hundreds of ounces of paper silver being traded through futures and options. The system functions effectively because 95% of traders do not actually desire the metal. They are merely speculating on its price. They extend their contracts or settle in cash. Only a small fraction ever approach the vault and demand, "Deliver my silver." However, this ratio is undergoing a dramatic shift. In the most recent delivery cycle, 9% of the open interest elected for physical delivery. This is nearly double the historical norm, and the preliminary data for the forthcoming month indicates an even more extreme situation. Some projections suggest that 12 to 15% of all contract holders will demand physical metal. Let us examine the arithmetic of this predicament. Currently, there are approximately 160,000 open contracts for silver. Each contract represents 5,000 ounces. This signifies claims on 800 million ounces of silver circulating within the paper market. If 15% of these individuals demand their metal, the exchange will require 120 million ounces of physical silver. However, recall that there are only 32 million ounces in the registered vault. It is mathematically impossible to deliver 120 million ounces when you possess only 32 million. When this occurs, the exchange will default. They will declare force majeure. They will inform the purchasers, "Regrettably, we do not have the metal. Here is some cash in lieu." However, the instant that transpires, the pretense collapses. The paper price becomes irrelevant because everyone realizes that the paper does not genuinely represent the metal. The third crisis is the one that virtually no one in the media is addressing: counterparty risk. Beyond the public exchanges, there exists a substantial clandestine market for silver. Estimates suggest that between 5 billion and 10 billion ounces of notional silver exposure are held within these private contracts. A significant portion of this is held by entities that are short sellers. They have sold silver that they do not actually possess. However, as the price of physical silver begins to diverge from its paper counterpart, these short sellers are starting to experience significant financial strain. Morgan Stanley can discern this because they are integrated into the interbank lending network. They can observe which other financial institutions are suddenly desperately seeking collateral. They can see who is drawing down their emergency credit facilities. What they are witnessing is that several major players in the silver arena are confronting a liquidity crisis. If even one of these entities fails to meet a margin call, the contagion will spread with alarming rapidity. In a globalized financial system, every bank is interconnected with every other bank. If Bank A collapses due to a silver short position, Bank B consequently faces a deficit on its balance sheet. It is akin to a row of dominoes. Morgan Stanley has assessed the situation and recognized that the initial domino is beginning to teeter. They do not wish to be present when it falls. They are exiting now so that when the counterparty collapse commences, they will already be holding cash. These three crises are not occurring independently. They are exacerbating one another, generating what is termed a doom loop. Morgan Stanley's analytical models indicate that once this loop attains a certain momentum, it becomes exponential. It commences with the declining inventory. As the public observes the dwindling vault levels, they experience apprehension. They think, if the silver is running out, I should secure mine now. Consequently, an increased number of individuals demand physical delivery. This depletes the vault even more rapidly. As the vault diminishes, the financial institutions that are short silver realize they are trapped. They are unable to procure the metal required to cover their positions, compelling them to frantically attempt to purchase silver in the open market. However, their buying pressure drives the price upward. As the price escalates, a greater number of individuals seek to acquire silver as a hedge against inflation, further depleting the inventory. Concurrently, physical premiums begin to surge dramatically. When the premium rises substantially, it signals to the world that the paper price is misleading. This prompts even more individuals to abandon the paper markets and demand physical metal. The cycle perpetuates itself with increasing velocity until the system ultimately collapses. Morgan Stanley's data indicates that we are already within the acceleration phase of this loop. According to their projected timeline, the window for exiting before the impending explosion closes at the end of this month. This is not a mere conjecture. It is a mathematical projection of when the system's stress will exceed its breaking point. To comprehend the rationale behind Morgan Stanley's urgent actions, one must examine their institutional history. They have witnessed similar scenarios unfold previously. In March of 1980, the Hunt brothers had amassed a substantial hoard of physical silver. The price had soared from $6 to nearly $50 per ounce. The major financial institutions found themselves on the losing side of that transaction and were incurring immense financial losses. However, what transpired? The exchange unilaterally altered the rules overnight. They implemented liquidation-only trading. While selling was permitted, purchasing was prohibited. This caused the price to plummet and led to the downfall of the Hunt brothers, but it preserved the financial institutions. Morgan Stanley retains a vivid memory of this event. They are aware that when a market disintegrates, regulatory bodies will intervene and modify the rules to safeguard the system, and when the rules are altered, someone invariably becomes a scapegoat. Morgan Stanley is determined to ensure that they are not that party. Consider the events of 2008. The financial institutions that acted promptly, those that divested their mortgage-backed securities while a market still existed, survived. Those that hesitated, such as Lehman Brothers, ceased to exist. Morgan Stanley itself narrowly avoided insolvency in 2008. They internalized the ultimate lesson of Wall Street. When systemic risk is apparent, do not delay to be proven correct, simply disengage. They observed a similar situation in 2022 with the nickel market. A massive short squeeze propelled nickel prices from $20,000 to over $100,000 per ounce. The exchange suspended trading and effectively nullified billions of dollars worth of transactions. Those who were profiting on the long side had their gains rescinded to protect the short-selling insiders. Morgan Stanley perceives analogous warning indicators in the silver market today. They are resolved not to be the ones left holding the liability when the exchange inevitably halts trading. If Morgan Stanley is aware that the system is on the verge of collapse, why are they informing their clients? The answer is twofold: legal protection and strategic self-interest. Firstly, there is the matter of fiduciary obligation. If Morgan Stanley divests its own holdings but remains silent while its clients sustain losses amounting to billions, they will face litigation. By issuing this memorandum, they are establishing a documented record that states, "We provided a warning." Secondly, they require an organized withdrawal. If every entity attempted to liquidate all their assets simultaneously within a single hour, the market would experience an instantaneous flash crash. By establishing a month-end deadline, they are attempting to manage the exodus. They are distributing the selling pressure to enable them to liquidate their own substantial positions without precipitating a complete market meltdown. This is not an act of benevolence. It is a calculated strategic withdrawal, and it offers a rare glimpse behind the scenes. The majority of retail investors are observing their trading applications, seeing silver priced at $30 and believing that all is as it should be. They remain unaware that the major players are already halfway out the door. By the time the general populace comprehends that a collapse is imminent, the avenues of egress will be obstructed. When Morgan Stanley commences its withdrawal in earnest, it will transform into an overwhelming force. 2. Exit all positions. They must liquidate both their long and short positions. When they close their short positions, they are compelled to buy. This will induce sudden, dramatic price surges. When they close their long positions, they are compelled to sell. This will induce sudden, dramatic price declines. These significant price fluctuations will trigger stop-loss orders for countless retail traders, thereby intensifying the market volatility. However, recall the directive. Prioritize orderly liquidation. Morgan Stanley is unconcerned about selling at the peak price. Their sole objective is to close out the positions. When the most influential entity in the market ceases to prioritize price, the market structure unravels. You will observe bid-ask spreads that defy logic. A bid of $27 and an ask of $32, a $5 discrepancy. This signifies that the market makers have effectively ceased their operations. This is the liquidity death spiral, and we are merely weeks away from its onset. As we approach the conclusion of the month, you will witness a profound divergence. Typically, paper silver and physical silver move in tandem. However, in a systemic collapse, that correlation disintegrates because institutions are liquidating paper assets. You may indeed observe the spot price decline, yet concurrently, the price of a physical silver coin will remain stable or even appreciate. The holders of physical metal will observe the chaos and will refuse to sell. This will lead to a situation where the official price is $30, but a dealer will charge you $50. This is precisely why Morgan Stanley is advising its clients to divest all holdings. They are aware that the price is about to become an illusion. If you possess a paper contract, you are holding a promise that may not be fulfilled. Why is the end of this month the inviolable boundary within a titan like Morgan Stanley? It represents a moment of complete disclosure. On the final day of the month, financial institutions are mandated to conduct mark-to-market accounting. Every single position they hold must be valued and recorded on their official balance sheets. These figures are subsequently subjected to rigorous examination by the Federal Reserve and global regulatory bodies. If they are holding substantial silver positions that reveal catastrophic losses, it impacts their capital ratios. If their capital ratios fall below a critical threshold, the bank's credit rating could be severely downgraded. By mandating the closure of all positions before the month's end, Morgan Stanley is executing a balance sheet purge. They aim to be in a position to declare, "We have zero exposure to the silver crisis." This is also the reason they are compelling their clients to liquidate. If a major client experiences financial ruin, the bank often becomes responsible for their margin debt. By clearing their positions now, the institution is shielding itself from the impending turmoil. At this very moment, you are existing within the temporal gaps. This is the interval between when the astute investors recognize an impending disaster and when the general public experiences its impact. If you examine the financial news today, what do you observe? You see commentators discussing interest rates and employment figures. This represents the illusion of normalcy. However, beneath the surface, silver contracts valued in the billions are being systematically unwound. The mainstream media will not report on this memorandum because the entities that own the media outlets are the same individuals attempting to liquidate their positions. They require your capital to remain within the established financial infrastructure. Your role is to supply the necessary liquidity, enabling their transactions without premature price depreciation. Historically, during significant financial downturns, the prevailing public narrative consistently assures normalcy until the very moment of crisis. Morgan Stanley is not awaiting public pronouncements. Their actions are informed by data. This data indicates that the stable phase of the current market cycle has concluded. Therefore, the crucial question is how to respond to this intelligence. You must transition your thinking from that of a speculator to that of a risk manager. The initial step involves assessing your exposure. Examine your investment portfolio. Do you possess silver? More importantly, what is the nature of your ownership? Holding silver through an exchange-traded fund or an unallocated account essentially means possessing paper. In a period of fundamental market shifts, paper-based instruments are the first to falter. You may discover that your silver ETF has been liquidated at a price determined by the exchange. The second step concerns the window for conversion. You have a limited time frame, approximately 3 weeks, potentially less, leading up to the end of the month. Your primary objective should be to convert as much of your paper-backed exposure into tangible assets as feasible. Acknowledging that this will incur a premium is essential. Currently, this might involve a cost of $10 above the spot price. Avoid adopting a retail perspective. An institutional viewpoint prioritizes securing a tangible asset, even at a higher cost, over a potentially worthless paper claim. The third step is to diligently monitor key data points. Cultivate your own analytical capabilities. Review the inventory reports from the COMEX Vault daily. If the registered category falls below 25 million ounces, you enter a critical risk zone. At this juncture, an exchange default becomes highly probable. The fourth step is to brace for extreme price fluctuations. The paper price of silver will exhibit erratic behavior, akin to a celestial body nearing its demise. When short positions are covered, expect sharp price increases. Do not interpret this as definitive success. Conversely, when long positions are liquidated, anticipate price plunges. Avoid succumbing to panic and selling. If you hold physical silver, disregard the fluctuating spot price. The only relevant valuation is the cost to reacquire that silver should you liquidate your holdings. I understand there are viewers who remain unconvinced. You might believe that financial institutions frequently divest their positions and that reports of a silver squeeze are perennial without materializing. This represents the skeptic's fallacy, the assumption that past inaction guarantees future impossibility. Observe the broader economic landscape. We witnessed the collapse of the nickel market and the instability within the regional banking sector. The silver market, in contrast, is comparatively small yet highly leveraged. If Morgan Stanley's analytical models are prompting an exit from a profitable business segment, the underlying financial imperatives have reached a critical juncture. What is the downside risk of aligning with their strategy? If you acquire physical silver and no immediate market event occurs, you still possess a tangible asset. However, if Morgan Stanley's assessment proves accurate and you maintain your paper holdings, the potential for total loss is significant. The risk-reward calculus is unambiguous. When the most astute market participants are initiating their departure, it is prudent to follow suit. While this advisory serves as a catalyst, underlying geopolitical pressures are also at play. For an extended period, the Western financial system has utilized the paper-silver market to artificially depress prices. However, the global economic order is shifting, with other nations no longer participating in this dynamic. In Eastern economies, particularly China and India, there is an immense demand for physical silver. Savvy investors are acquiring silver at its undervalued paper price in New York, subsequently transporting it to the East for sale at its true market value. This is the very force depleting the COMEX vaults. Moreover, silver has become an indispensable industrial component for the green energy transition. Solar panels, electric vehicles, and advanced weaponry all necessitate substantial quantities of silver. We are currently experiencing a global structural deficit in silver supply. One can generate an abundance of paper-silver contracts, but it is impossible to manufacture even a single ounce of physical silver. Morgan Stanley is withdrawing because they wish to avoid being caught in the midst of a failed exchange. We are now entering the final phase of the existing silver market structure. You will observe the progression of physical supply from in stock to delayed, and ultimately to sold out. This signifies the concluding stages. If you hold silver in paper form, you face a critical decision. If you possess physical silver, you have already secured your position. Do not permit the paper market's volatility to force your hand. Those who navigate this transition successfully will be the ones possessing significant purchasing power in the emerging economy. Morgan Stanley has provided you with a 72-hour advantage over the general populace. Information is the sole differentiator between those who succeed and those who falter. The opportunity to exit remains available, but the flow of individuals moving towards it is intensifying. Delay not until the point of a chaotic rush. This is not an unforeseen event, but a documented and unavoidable consequence of a flawed system. Morgan Stanley is disengaging. Their clientele is also seeking to divest. The pertinent question is not their action, but rather your intended course of conduct. The commencement of the countdown has been signaled. Utilize your time judiciously. Once the month concludes, the pathway represented by paper instruments will vanish. The sole determinant of value will be the assets held directly in your possession. Liquidate all positions before this critical juncture is reached.